Rick Santelli standing by at the CME in Chicago with all those numbers. Hello, Rick.
Yes, hello, Mike. And we can see that yields are dropping. The data is trickling in. Let's start out with jobless claims. 228,000. That's below expectations of 235,000. And 228,000 is the lightest, well, in the month of August. You have to go back to the last week in July. Continuing claims from the week of August 19th, always a week in arrears, 1,725,000. Very close to expectations. 1,725,000 actually is the highest level, going all the way back to the first week in July. Now, personal income and spending income up 0.2, 1/10 lighter than expectations. If you look at the spending side, 1/10 stronger than expectations, up 0.8%. Up 0.8% is the second best number of the year outside of January, whereas at 1.9%. If you adjust for inflation, real spending up 0.6. That's pretty juicy. Also, the second highest number of the year outside of January's 1.3. Now, buckle up. The money ball, 4 sets of numbers. The month-over-month, year-over-year, some of the favorite inflation gauges of the Federal Reserve. The PCE deflator on a month-over-month basis is up 0.2%, exactly as expected. The light watermark, the low watermark this year has been 1/10, and that was twice back in May and also in March. The high watermark, June of 22, where it was up 1%, the highest since 1981. If we take a deflator year-over-year look, up 3.3, exactly as expected. However, it is 0.3 higher than our last look, which was 3.0. That's never a good thing. High water mark there, June of 22 at 7%. That was a 1981 comp. If we look at the core deflator on a month-over-month, up 0.2 as expected. Up 0.2 is pretty much where we were looking for this to come in. The best it's been, well, it was up 1.17 our last look. That's rounded to 0.2. I think it's an important distinction, and maybe the most important number of all. The personal consumption expenditure, core deflator year-over-year, 4.2. 1/10 hotter than our last look at 4.1, high water mark there. 5.41% in February of last year. That was a 1983 high. And what is noteworthy here is that we obviously have been in this 4% range, and many analysts, economists, and Fed officials have pointed to this as the sticky area. Interest rates did move lower. We're very volatile, but we're hovering at 408. 409, maybe 1/10 difference. If you look at the pre-opening equities, they are still on fuego. And to me, all you have to think about is what occurred last week. Jackson Hole, stocks are up how many days in a row? I think we could connect the dots there. What is one of the motivating forces of stocks? Mike Santelli, it's all yours.
Yes, sir, Rick. And stay with us for more on all this. We want to bring in senior economics reporter Steve Leisman, along with Lindsay Piegza, chief economist at Stifel, and Kayla Brune, Morning Consult senior economist. Welcome to you all. Steve, what stands out to you from these numbers?
Well, you had goods deflation. I'm just reading this, make sure I got this right. Prices for goods decreased 0.5%, for services up 5.2%. That's the year over year. For the month, goods prices were down 0.3%. And services increased 0.4%. So pretty strong, reasonably strong service inflation. I can't tell, Mike, whether or not that financial commissions or stockbroker commissions pushed up the service sector number. I don't have the detail in front of me here, but that was the suspicion going in. Stability, I guess, is the way to say it on the service side. Not making more progress. Maybe, again, that was pushed up on the core and the headline number as well. Looks like it was pushed up. Not exactly clear what pushed up the headline here. I see energy prices were up just 0.1% and food up 0.2%. So something else is pushing that up. But the big number, I think, from a GDP standpoint, is the big spending number, up 0.8%. And yet you see income coming in below. That did not come from compensation, which did pretty well. It was personal transfers, government transfers, I guess, is the big part of that, seemed to come down. But it still does augur, for sure, for less robust spending in the month of August. But because of the way we start here, Mike, the importance of the starting point of the quarter in the way GDP is calculated. I think that still means we're going to be running, I don't know what the numbers are, 4, 5, 6% on GDP in the third quarter, with some expectation that it slows down in the fourth.
Right, yeah, that hot July working its way through. Lindsay, so we have a little bit of a stutter step, I guess, in the disinflationary progress, but as expected, and I think, isn't it true that we've really had a general lack of surprises on the inflation data? People seem to have a pretty good handle on the trend. Does that give you reassurance, or where do you think the inflation is ultimately going to be settling?
No, unfortunately, just because it came in as expected, I don't think that offers enough reassurance to the Fed, which wants to see continued disinflation, very strong disinflation, back to that 2% target. So the fact that we are seeing a reversal with a spattering of price increases across different categories, I think this reinforces the Fed's message that we heard from Jackson Hole, that the Fed's job is not yet done, and they need to stay focused until that job of reinstating price stability is in fact achieved. So I think this is going to put a lot of pressure on the Fed, despite market expectations, for them to continue to move forward with additional rate hikes, potentially as early as next month. So I do think that this is a step in the right direction in terms of declining price pressures from the peak. But when we look at the economy, still very robust, the consumer still very resilient, and inflation now reversing course, now is not the time for the Fed to take a passive position on the sideline.